also welcome in Jyoti Vardhan Jaipuria, the founder and MD of Valentis Advisors. So, firstly, to start off with, the markets have been quite volatile for the last 3 months. We have seen a sharp fall. Obviously, we have recovered from the lowest that we had seen, but we are still considerably away from the high levels that we had seen for 2024. Do you think that the valuations at this moment are reasonable enough for investors to go ahead and put in their money, or there could be much more consolidation going forward?
Yeah, so I guess when we are looking at the fall over the last 3 months, what we should remember is the market had a sharp rally this year than for the last 3, 4 years. So to that extent, valuations had become, I would say, quite expensive. They've become a little better than they were with the fall, but even now, I would say they are, probably still not what I would call very, very comfortable levels. My view is probably what we get is from here, maybe a bit of price correction, but we also get a time correction which helps lower the valuations down. So we would be thinking that the markets probably consolidate in a range. It become range bound for the next few months, and that helps bring valuations to the fair value zone.
And what could be that key trigger point for the market to move higher?
So there are two things which are weighing. So one is valuation, other is the fact that the earnings have started to slow down. So in the September quarter, it hit the market a lot that earnings are not doing well. The economy is probably slowing down, and there were downgrades which were there. But for us, the way we were looking at it, even the June quarter was disappointing. So we had 2 quarters of subpar earnings growth. So one is, probably if you think of what can create an upside, it is the fact that the economy starts to do well and earnings start to recover again. My guess is maybe December quarter may be slightly better or more or less similar to the September quarter, but hopefully the March quarter will be better. And I think that will be led by two, three things. One is the government starting to spend again. So if you see government capex, the first 6, 7 months, they've done only 40% of the budgeted spend. So hopefully, if they can get that spending moving up, that will help the economy. The other is the fact that the monsoons have been good, the crop has been good. So to that extent, we see that income starting to come to the farmers and they start spending. And third is, as we know in the last RBI policy, they include liquidity in the system with a CRR cut. So that 1 lakh odd crores which will come into the system, that will start helping earnings also probably in the December in the March quarter.
Mr. Jaipuria, hi, this is Ankita also joining in. Sir, another point of concern, on the macro front has also been the strength of the dollar index and, the weakening of the rupee. It hit its all-time low last week, as we saw. Now, if that is likely to continue, if the dollar strength is likely to continue because there are lesser rate cuts now, come next year, if the strength continues, how is that going to impact the FII selling, which they have already been selling for, they have been net sellers in the last 3 months. If that selling intensifies, how does, is that going to weigh down the markets further if the dollar index strengthens?
Yeah, so Ankita, you're right. So basically what we've seen over the last 3 months is the fact that the dollar strengthened. Generally, money flows away from emerging markets when that happens. So if you rewind back a few months back, there was a stimulus in China, and money started moving away from India towards China. And then after that, the strength of the dollar and probably the fact that President Trump became the president designate, he won the elections. That meant that there was money flowing away from all emerging markets, and India is part of it. It was flowing into the US. And that phenomena so far seems to be continuing. So at some point, the thing is either the dollar strength starts to slow down because, the market anticipates everything. And so to that extent, the fact that the rates are getting cut much more slowly is also probably starting to get built in. And at some point, I think the dollar will start to maybe stagnate and be in a narrow range again. So that probably helps us a bit that, FI flows, which have been quite negative, start to, at least the negativity starts to slow down. And along with that, if we have the fact that, the domestic flows continue, then that will start helping the market. But I think the critical factor globally, which everybody is looking for, and nobody has an easy answer, is on 20th is when President Trump actually gets sworn in. And then what is his policies after that? Because there'll be a lot of noise, tariffs coming, rate cuts in the US coming, or tax cuts in the US coming. So, one is what people say before elections and before they come to power, and the other is what they actually do when they come to power. So I think for markets globally, that will be the moment where, his policies actually start to come about. And whether they are good, they're bad, there'll be some, I'm sure, which are good for the market. There'll be some which may be good for US markets and not so good for emerging markets. So that is something which we'll, have to keep a track on.
Right. Sir, amid this kind of market setup, which are the sectors that investors should focus on currently?
So, we tend to be a little maybe contrarian, one can say, but most of the time we are always looking for value. Our whole investment philosophy is the three U's where we, one of the U's is undervalued, but the other is underowned and underperforming. So for us today, what really stands out as value is the ones which are not done well. So financials is one sector which is standing out. Financials is amongst the only sector where today, the valuations today are lower than what the 10-year average has been. Whether on a price to book on a P, financials is probably the only sector along with media which is looking cheap. So there are obviously short-term concerns here, but we started nibbling at them. So this is a sector you want to own for the next 18 months. It probably won't give you returns in the next 3 months. And you don't need to put all your money today, but you think of it as over the next 3 months, I'll buy that. So that's one sector I would highlight, the banking sector. The other would be the pharmaceutical sector, because that is something which earnings are good. In the US, the pricing pressures eased off quite a bit on the generic side. There could be positive news on the biosecure because, like whatever Trump's policies may be, in general, we can say that, it probably will hurt China more than it hurts India. So to some extent, on a very relative basis, it will help India. So I think a lot of the CRAM companies in India probably over the next 3 years, 5 years will get benefited by policy changes in the US. So pharmaceutical is the other sector which I think looks very interesting.
Right, Mr. Jaipuria, speaking of sector specifics, what's your take coming in on the QCOM space? I mean, we just saw Zomato entering into the BSE Sensex today. It's making its entry. What is your take coming in on that? It's a duopolistic market for now with the Swiggy and Zomato, but the competition is really heating up with, a Zepto and also Amazons of the world coming into the 10-minute delivery space. What's your take on the Q-commerce space?
Yeah, so, the way we work and our framework, we've not really bought these stocks and obviously they've done very well. These are sectors where, I think the market will be bigger than what it is today. The market will grow quite a bit in the end, but because, like you said, competition is coming in, there'll be a lot more players trying to capture that increased market share. And, the stocks are not like cheaply priced. So the margin for error in a lot of them is low. If you get, one player really knocking off some of these from the perch, then that will start to hurt them. And we tend to buy stocks where we see a lot of margin for safety. We don't really see them in some of these listed players today.
Right. And how are you looking at the steel names? Obviously, there's a fundamental reason behind today's move, and that is the dumping duty coming in on import of steel. But do you think that the valuations are reasonable at this point of time? And if such a move comes in from the government side, the stocks could, the earnings could re-rate at least for them?
Yeah, so, anti-dumping always helps these guys, right? But for us, it is, we have very limited ability to, figure out what the government is going to do. When we step back and think of steel, for us, it is, China is one place which is going to slow down. And especially investments in China is going to slow down. They have like 50% of the steel market. So to that extent, when the largest market for steel, and not just the largest market, it's a substantially large market for steel, is going to slow down. Over the next 3 or 4 year basis, that steel prices are not going to fly. They are probably going to be flattish to slightly under pressure. And the chances are that China may end up dumping more and more steel across the world. So that has been the concern for us. And so we stayed away from a lot of these global metals where the pricing power is linked to China. And that continues to be our view. Some of these, anti-dumping duties help them in the short term because, it obviously increases the price at which they can sell. But for us, it is like, trying to comprehend these is like not our strength, I would say.
All right, Mr. Jaipuria, on that note, thank you so much for joining us today and taking the time out. With that, we'll let you go on that note. But
if you like this video, then like, share and subscribe to ET Now.